Good evening, everyone. Thank you for joining us tonight for 51 Bets. I'm Melanie Brensinger. I'm one of the co-founders of Anagenesis Capital Partners, and I have two of my colleagues here with me as well, Brian and Iche. And Brian was a senior associate and last week was promoted to vice president at our firm. And Iche is an intern for us. She's in her second term of an internship here, and she currently is at Stanford University. And I'll allow each of them to give their background as well. But we're excited to be here. We're also excited to be here with our co-host, Greg from Windjammer as well. And Greg, feel free to jump in with any insights and feedback for us from a private equity perspective. In terms of my background, I've been in the financing space for 20 plus years, always focused in on working with private equity firms around debt and equity financing to support what they're doing at their respective firms. I was at GE Capital in the healthcare financial services team for about 9 years before co-founding Anagenesis Capital. Really focused in on the healthcare space. During that time, I deployed over $2 billion of capital for that platform and did 50 plus deals with them. So very deep in the healthcare space. Founded Anagenesis in 2015 with my partner. Went out, we raised a fund, which we're now deploying, built out our team, and we're 100% focused on healthcare. So excited to be here this evening. And I'm really fortunate, again, to be here with Iche and Brian. They've done a really nice job of pulling together a deck for you, which we're going to walk through. And you're going to be able to hear insights from them through the eyes of a vice president as well as a current intern. And hopefully that'll be helpful for you. We want this to be interactive. We want you guys to ask questions as we go along the way. But perhaps before we kick it off into the slides, I'll turn it over to Brian and Iche for you to each talk about your background and what you do at Anagenesis, and then we'll flip into the slides.
Yeah, Brian Choi here. Excited to be here and be part of this discussion. So just on my background, yeah. So I joined Anagenesis about 8 months ago now, back in May of last year. Before that, I spent my time at Capital One Healthcare, GE Capital Healthcare platform, along with Melanie, as well as my other colleague, Scott Clark. And then sort of worked on the similar sort of debt underwriting and portfolio management, and then been in that industry for about 7 years, again, focusing on the healthcare deals only. And then, Scott and Melanie kind of brought me over to this platform, again, earlier in the last year, and have joined this, this great platform and then been working on deals ever since. So, I mean, again, thanks for having me in this conversation and in the discussions, and looking forward to getting to know you guys more and then just, having this dialogue.
Great. Thanks, Brian. Iche, you want to give your background?
Yeah, sure. Hello, everyone. Nice to meet you all. I'm a junior at Stanford University, majoring in mathematics and computer science and minoring in economics. I'm a research assistant at Stanford's Digital Economy Lab, which is part of the Institute of Human-Centered AI. And as Melanie said, I've been an intern at Anagenesis last summer and this winter, and I really enjoyed my experience so far.
Great, thank you. And Greg, since you might interject with some thoughts, which I hope you do, would you mind giving it just a brief introduction for yourself as well as my co-host?
Hi, Greg Bondick with Windjammer Capital. I've been I was kind of a founding person for our East Coast office, but I've been running the firm now for a couple of years with a couple of my partners. So we have about an $875 million fund right now, and excited to be here and excited to listen to this today. I'm sure it will be fantastic. So, but if there's any questions as it relates to PE, I'm happy to jump in.
Great. Thank you. With that, Jordan, I'm going to share my screen so we can jump into the slides. In terms of an agenda, if you look here, I'll chat a little bit about, we touched on it a bit, but who we are, what our firm does, and then we'll touch on a little bit about different ways companies find financing sources. Sometimes people think, gosh, back in the day, everyone would go to banks for financing. And now there's this evolution of private credit funds out there and a whole host of different types of private credit funds. So we'll touch on a little bit of that, talk about how private equity plays into the financing sources as founders think about getting capital for their businesses. Then we'll walk through our investment process, focus on our diligence process. Brian will walk through how we look at deals, how we think about deals. We'll walk through just our whole way that we transact as a firm. And then we'll touch on a little bit around origination and sourcing deals. Brian will walk through an example of our pipeline of deals that we're looking at, how we track our pipeline, what our hit rate is within our pipeline. And then we'll do a deep dive into a case study of a deal that Brian and I closed on late last year called Project Lighthouse. And we'll touch on all the different aspects of that deal. And then we thought it'd be really helpful for Brian to walk through kind of key skills in which are required at the senior associate VP level through his perspective. And then have tips from an intern. And Itche will walk through as an intern, some things that she does to be really successful within her internship. Feel free along the way to stop us with any questions or thoughts or comments that you have. And Greg, also, when we touch into the financing sources and touch into the private equity too, feel free to jump in and provide feedback there as well. So with that, just turning forward to our firm, as I mentioned from the onset, from my introduction, we are a healthcare focused private credit firm. We were founded in 2015. We raised our Fund 1, which is a $274 million SBIC fund. We're currently deploying that fund. We have a portfolio at this point of 10 portfolio companies, one of which we exited. Brian, I'll touch on some of the companies that we're involved in so you can get a sense of our portfolio. But this slide just really lays out, we have a differentiated investment strategy because we are 100% healthcare focused. We think healthcare is a good sector to be in. It's growing, it's non-cyclical in nature. Obviously, as you guys see from the current pandemic, if you look even at our portfolio through COVID, it held on and remains quite strong, as many of our businesses were considered essential businesses, as you might imagine, through the pandemic. And we have deep relationships with executives, founders, investment banks, really across the board from a healthcare perspective. We have an executive advisory board that is made up of executives in the healthcare industry, and they help with us with diligence. They're an investor in our fund, and just are great people to have around our organization. From an investment perspective, we invest in companies with ideally greater than $2 million of Ebitda, but we are truly in the lower middle market. So kind of 2 million of Ebitda and up from there. Essentially on the higher end to around 15 million of Ebitda. We are first and foremost a private credit fund, which means that, for example, if we're deploying $10 million of capital, 8 million would be in some type of debt instrument, and 2 million would be in some type of equity co-investment. So we typically take an 80-20 split. Sometimes that can change depending on the deal, but that's our ideal metric between debt and equity. We don't do control equity deals, so we are truly taking minority positions either alongside of a sponsor or alongside of founders of businesses. We do, as I mentioned, back private equity firms, but we also back direct founders where a private equity firm is not involved. For our fund, we're targeting 12 to 18 investments per fund with around $10 to $25 million per transaction. And sometimes we are the only debt provider, or at times we may partner up with other debt providers. And then for all of our deals, we have some level of board participation. From a structuring perspective and return perspective, we do everything from senior debt to junior debt. On the equity side, we can do preferred debt. We can do, preferred equity. We can do common equity. The key of our firm when we came together, we wanted to be healthcare focused, but we also wanted to be able to provide flexible solutions for borrowers. There's a lot of mezzanine funds out there. There's a lot of senior debt out there. There's a lot of private equity, but we didn't see any other fund or any other vehicle which was healthcare focused that could play up and down the capital structure and really provide flexible solutions for our borrowers, and that's a real competitive advantage as we look to source deals. In terms of our interest rates and how we think about providing returns to our investors, our debt instruments have interest that's returned to our investors, of course, and then our equity piece provides capital appreciation, similar to like a private equity firm. They're, on some type of event or a sale of a company, that return then goes back to our investors as well. And as I mentioned, we're an SBIC fund. So essentially what that means is we're governed by the Small Business Administrations. We're licensed through them, and they're really focused on providing financing back to small businesses across the United States. So there are some governors around size of companies that we can look at, and they're also really focused on serving underserved areas of the country as well as underserved populations. So we're really excited about that because it fits within our culture and our values for our firm. So if no one has any questions on that, I'll flip to the next slide, which is really around thinking about, oh, sorry, before I do that, Brian, do you want to just touch on our portfolio and maybe give the guys some color around what type of businesses we're invested in so they can get a general sense of what we think about when we think about healthcare?
Yeah, happy to. By the way, can you guys hear me okay now?
Yeah.
Okay, good. Yeah, just to kind of briefly touch on our portfolio today, we have 9 active companies in our portfolio. We do have a lot of physician practices platform in our portfolio. And what that really means is that it's a roll-up, basically, right? Roll-up of 20 to 30 different practices. We have a portfolio company platform that provides dental services. We have a platform for ophthalmology, podiatrists. We also have a company that provides treatments and care for people at home. This one's not necessarily a roll-up play, but regardless, a platform. And then we also have a behavioral health company that we'll actually talk about later in the case study. So, yeah, I mean, there are a lot of different subsectors within healthcare, as you can imagine. Healthcare is very wide. It goes from healthcare device manufacturing to pharmaceuticals, to healthcare IT, and to physician practices. So a lot of opportunities within healthcare, and we do look across the verticals, and then that's why we like to specialize in this specific industry as well.
Guys, can you clarify what is a platform, what is a add-on, what is a roll-up, just some of the vocabulary?
Yeah, so platform is basically when you first acquire an asset, whether it would be a private equity buyer or even for us when we first look to invest in a platform. It's an established, I would say it's an established, set of practices, whether it has, already 5 or 10 practices in it, with some sort of infrastructure as a setup, so that you're sort of, what you're looking to do is to go out and add on, like a small mom and pop providers into the existing platform. So that's like the platform, and then the role play that we see quite a lot in private equity as well as private debt. So that's how we think about the platform.
Awesome. And
maybe the add-on, Jordan, is like taking that existing platform and just doing acquisitions to continue to enhance and grow the platform.
Okay. And maybe you could save this for later, but diving into some basic differences between like what is mezzanine debt from a high level, senior, junior, what is that from just a high level? And we can come back maybe into that later.
Yeah, sure. And Jordan, I'll touch on that a little bit on this slide that I'm on right now around private credit, traditional banks, and private equity. So to make it very basic, and I apologize if this is a very basic level, but one example that I like to give is, for example, if you're going to buy a house, you would go to, let's use Wells Fargo, for example, and they would say, okay, you're about to buy a house. We want you to put in, 20% down of your own money, and we're going to give you 80%. And with that, that's going to be the purchase price of your home. If you think about the thesis, Wells Fargo wants you to do that, so you're also invested in your home, so that you have quote unquote skin in the game. And so if you do that, Wells Fargo will then have essentially a first lien on your home through that first lien mortgage. Now, say for example, you own your home for 3 years and you say, gosh, I want to take, some more money out of my home. the value of the home has increased, and therefore I want to take what's known as a second lien mortgage or a second on your home. So that second lien mortgage might be at a higher rate. It will be at a higher rate than whatever, for example, Wells Fargo gave you. It'll give you some more money in your pocket. If the company, if you wanted to sell your house, for example, and your house was sold for $1 million, the first piece of that would go to pay off your first lien mortgage. The second amount would be to go pay off your second lien mortgage, and then the money would be returned to you for whatever was left. And that way that you think about a mortgage is very similar to capital structures within any given deal. So if you think about senior debt is like at the top priority of that structure. So in my example with the mortgage, senior debt would be equivalent to like Wells Fargo's first lien mortgage that you would have on your house. It's the first debt that gets taken out on a repayment. They have the highest priority, the highest claim to whatever the assets are, the cash flow, the enterprise value is for the company, and they are the most secured. Because they are the most secure and highest in the structure, they're also typically the cheapest cost of capital. Next, underneath senior debt, you have, and senior debt can take different forms. It can be a revolver, which is essentially like a line of credit. You borrow, you pay down, you borrow again, you pay down. Think about that like a line of credit or a credit card or something of that nature. It's just rolling and you pay down, borrow again. Then you have term debt within senior, which is long-term debt, meaning you borrow that amount of money up front and then you pay it back over time. Sometimes you're paying it back every year, every quarter. Sometimes you don't pay it back until the end of maturity and you pay the whole thing at one time. That's really senior debt. And that senior debt can be provided by traditional banks. So think about, Chase, Wells Fargo, all the Capital One, all the major banks out there. Regional banks also provide senior debt. And everybody has different kind of sweet spots of where they play in that. Then underneath the senior debt is junior debt. And junior debt can be different forms. You'll hear people say mezzanine, second lien, last out. It's all these different words. But really what it means is it sits behind somebody else in a repayment structure. So whoever sits on top of them is getting paid first. Whoever sits on top of them has the best terms from a security perspective and just protection of principal for the money they've provided. And then the junior people sit behind them. So for sitting behind somebody else, they get paid more money. So that usually translates into a higher interest rate before sitting behind the senior debt. And then behind those two tranches are the equity. And the equity can take many different forms. It can be preferred equity, which means it's at the top of that stack in terms of repayment. It can be common equity, which sits right behind preferred equity, or it could be both of those. Some structures have preferred equity and common equity. That equity can be held by management teams. It can be held by founders of the firm. It can be held by private equity firms like Greg and folks like that. And it can also be held by folks like ourselves that are debt investors, but also doing some equity alongside whoever's controlling those businesses. So that's how to think about, in general, a capital structure and how all of this fits together. So on this slide, we really just wanted to make some distinctions here around, as you see, traditional banks are typically providing senior debt. They might have a junior debt option below them. They rarely do equity. The major concern is just making sure that they get the amount that they gave the company back plus interest. And because of leverage lending guidelines and a lot of the rules that came into effect after the financial crisis of 2018, more often than not, traditional banks now are really rigid in terms of what they can do and flexibility within the capital structures, as well as how they can structure deals. And because of that, private credit funds were really born, and private credit funds have become such a huge piece of the market now. And essentially what private credit funds do is they're similar to traditional banks, and they're providing debt, except now some of them and most of them provide equity alongside of their debt instruments. Many of them, including ourselves, are set up like a traditional private equity fund, meaning it's a committed fund. Our investors are pension funds, endowment funds, insurance companies, family offices. They commit to our fund. They pay us a management fee, carried interest, and then we go out and invest those dollars on behalf of them. We have discretion over that pool of capital, meaning they made the decision to invest in us, and now they trust us to go out and find the companies and make those investments. Many of those funds, similar to private equity, are 10-year funds, meaning you have 5 years to invest the money and 5 years to get it back, with some extensions along the way, very similar to private equity. And the other difference, I think, is that many of them are not industry focused. Many are generalist funds. They're doing all sorts of different deals. So there are, I think for us anyway, we're the only pure play healthcare private credit fund out there that we're aware of. There could be some out there that we don't know, but that we're aware of. There are private credit funds who have, a healthcare team, or they might have 1 or 2 people that focus on healthcare, but nobody else that we know that are pure play healthcare companies. The other thing I might add is that when we think about healthcare, we don't do early stage healthcare. So don't think of us as like a VC healthcare business. So we're not doing anything that has FDA risk, meaning if that product on the pharmaceutical side or med device side needs FDA approval, we're not doing those types of deals. We're doing established healthcare businesses. Most of our businesses are services businesses, but we will look at pharma and med device, but we don't take early stage FDA risk. And then to the right around private equity firms. So you have private equity has now also taken many forms. For a long time, when people thought about private equity, they think about private equity firms like Greg's fund. It's a committed fund. It's a closed-end fund, meaning investors come in, they put their money to folks like Greg and say, go invest this money in great companies, find us the best deals, and deploy our capital responsibly. And they have a committed pool of capital. They have discretion over how they are going to provide that capital. Over the years, some other types of sponsors, I would say, have crept into the market. You'll hear things like independent sponsors, fundless sponsors are 2 kind of common other types of lingo that are out there. Essentially, they take many different forms. Essentially, if you hear like independent sponsor or fundless sponsor, that essentially means they don't have a committed pool of capital behind them that they have full discretion of that they're going to deploy. It could be folks who come together and say, let's use an example. I come together with Brian and I say, hey, we all know healthcare. Either we can't or we don't want to go raise a big pool of capital that we want to have discretion over. We want to go find a deal. And if we find that deal at that time, we'll go out and raise the money to make that deal happen. And then they get fees for finding that money. And sometimes some of them will play an operational role on a go-forward basis, and some of them will just, put the deal together, take a fee, and then sit on the sidelines. And then you have some deals where an independent sponsor will actually play together with a fund like Greg's fund. So you might have 2 types of sponsors involved there. So the point is, on the sponsor side, there's all sorts of different variations of sponsors. I think if you all are out talking to private equity firms or thinking about doing an internship with a private equity firm, or if you ever get the opportunity to also perhaps take a position in a private equity firm, or frankly, even a private credit fund, it's important to ask them, do you have committed capital? What fund are you on? Do you have dry powder within your fund, which means still has some money to deploy in deals? If you take a position with a firm that is completely maxed out for their fund, maybe they haven't raised their next fund, they're not sure what they're going to do, and you want to make sure that you're at a place that has long-term success, that can get a little tricky. Also, if they don't have committed capital, you have to just understand that your fate is decided by every deal, that they can somehow pull the deal together, generate revenue, and then pay you your salary, essentially. So those are some really important things to think about as you're thinking about longer-term placement at funds. But maybe with that, I'll pause for a moment. Greg, do you, you're definitely much more entrenched on the private equity side. Do you have any thoughts around, does Windjammer play with independent sponsors, or what's been your experience with interacting with some of those sort of non-traditional private equity sponsors?
Yeah, I think there are a lot more opportunities. Capital, is you guys hear about all the time, is very easy to get nowadays. So a lot of people don't want to go through the hassle of raising money like we've done and Melanie's done. I mean, it is a it is a grueling process. So a lot of them will try to find a deal and bring it to somebody like us and then cut economics. You know, we tend not to work with too many fundless sponsors unless they have a true unique angle on a deal, or they really understand the industry in a different way than we do, because a lot of them try to come and get full economics, which means they want a fee plus they want carry. I'm already being paid that by my investors to go back to my investors and say, hey, in addition to you paying me, you're now paying this other party. It becomes difficult unless you really feel like you can structure it in a way to make sure that everybody is doing well. You know, what we've seen is, you know, these were probably more prevalent, at least for us, in terms of deal flow a few years ago. And the only reason I say that is they used to be able to find proprietary deals. It's harder for them to identify deals and be able to bring somebody like me an opportunity because there's so many investment banks out there now. So, but clearly these still exist. And the Melanie's question earlier about making sure that somebody actually has fee income to be able to pay your salary is pretty critical when you start looking at these fundless sponsors.
But I think one of the important things to also note here on the independent sponsors, like you might find some that have like 5 portfolio companies and that's their route. And for those of you who might have more risk appetite and you want to get in early and you're working with one person who has 3 to 5 portfolio companies, and then if you have that risk appetite, then you can be part of that team and maybe either do an internship, or guess what? Then now you're the VP because you've been working your ass off for a year and you've proved yourself. We have a couple of those internships right now that are available. But I think another note here on the independent sponsors, many of you have heard of entrepreneurship through acquisition, or like the search fund model. That is a type of fundless sponsor. Guys, this was super helpful, and maybe we could put a pin on this, as well as Melanie, maybe later on the presentation, I don't know where, but talking about like turns of debt on a deal, what that means, senior, junior, et cetera. But this is super, super helpful to go through that.
Yeah, great. Thanks. So maybe we'll just pause here for a second because we're going to shift over here to Brian's portion of kicking it off into our process. Does anybody have any questions on what we've discussed thus far? No? Okay.
I think the breakdown really makes a lot of sense. So appreciate it. Like it probably felt pretty elementary to y'all, but like just being able to follow and see it is super helpful for me. Thank you.
No problem. That's great. Okay, with that, we will, sorry, hold on a second. We'll shift gears here and I'll turn it over to Brian to walk through our process and walk through how we think about a deal from sourcing to closing the deal.
Yeah, thanks, Melanie. Yeah, no, I'll walk through our sort of deal process, and I want to kind of start with the big picture here, right? This is a process map of how we think about in terms of what we do on a day-to-day basis. I try to break this down, which starts from sourcing the deals, which, by the way, we'll talk more about in the next couple of slides. It's a very difficult job, and an absolute key to success of the fund, because the quality of the deal flows really matter. And then the better the quality and higher the quantity of the deals that we see, we can pick better deals. That's just the deal selection, and it's as simple as that. But I would say as a senior associate / VP, we spend about 50 to 75% of our time on executing transactions and really managing the deal process, right? So these middle 3 boxes that you see here, and taking this from screening to underwriting to closing, and really managing the due diligence process, and that's where a significant part of our time is spent. And then the remaining 20 to 25 to 50% is really split between, assisting the sourcing efforts, which include reaching out, introducing our firm, and building relationships with the industry contacts, and obviously portfolio management once the deals are closed. Again, we'll give you more context as we go through the slides as what these stages specifically mean, and we'll reference the deal, but wanted to give you guys kind of like a big picture first. We'll kind of go from there. In terms of how you would think about a senior associate's role versus analysts or associates, I would say analysts really help out in any parts of these deal execution activities. doing a research here, writing parts of the investment memo, sometimes helping build out a model. A lot of analysts are usually coming right out of undergrad or has only like a couple of years of experience. And the objective for them is to really learn, right? Learning about the industry, how we operate. And then the associates are a bit more experienced. By the way, these are not senior associates, more like a junior associates, but, they can help run diligence, should be very proficient with the models. They know how to think about the investment thesis and risk. And they should also be able to develop, a good chunk of the investment memo as well. So that's their role. And as a senior associate and VP, I would say you're more in charge and then managing the full process, and really forming well-vetted opinions and making investment recommendations. So I think that's how I would think about the distinctions between some of the more junior roles and as you move up to senior associate and VP role. And by the way, a lot of times, people coming out of the MBAs, they'll be joining firms, probably at the senior associate level. So I wanted to highlight that as well. I think we can go on to the next slide.
Sorry, go ahead.
So this is sort of like another framework for how we think about the deal process, specifically in the middle section from the previous slide, the transaction execution stage. Once we had a deal, then this is sort of how we think about it. So, once we have an opportunity, and meaning we would usually have an overview material on the company. I think Greg mentioned it last time too. Usually it's what's called a SIM. It's a confidential information memorandum. It's a 40-page to sometimes 100-page long document that gives an overview about the company and the opportunity. And then we would read through that, right? We would read through that and then start to develop a thesis, an investment thesis. And we also start to think about, what the key risk areas are and what are some of the areas of diligence that we'll have to dig into in order to mitigate the risk, right? So sort of hypothesizing is where we begin. Then we look to validate the thesis and then really look to cover the risk. And again, how we do that is we start with the due diligence, right? You start to learn about the industry that the company operates in. You learn about the business model, the financials, and the historical track record. You learn about the management team, and then we conduct legal diligence as well. And this is not an exhaustive list, right? I mean, you can diligence whatever you think are critical for the success of the business. I.e., if you're in like a chemicals industry, then I would think that environmental due diligence is critical, right? And because we're in healthcare, and I'll talk more about this later too, the reimbursement due diligence is very near and dear to our heart, and that's an important aspect that we focus on as well. And then just to hammer on that point again, the due diligence is really critical. At the end of the day, it's really about getting a thorough understanding about the business and then the environment that it operates in and the people that operate the business, and then really covering the risk and then minimizing the surprises, right? And you can take the risk, I think, if we can identify the risk and well mitigate it and get compensated for it. But, if you fail to identify the risk and really invest blindly into something, I think that's just another form of speculation. So due diligence is something that we heavily focus on. And once you sort of conducted your due diligence, you build a financial model to think about the future projections. And then it all becomes part of how we think about the pricing, how much debt we put on the company, and legal negotiation as well. So, this is a full circle, but it's also important to note that, this is a continuing process, right? The loop doesn't just happen once. When you get new information, you try to understand, refine your model. And obviously you can't negotiate every time you get new info, but we should have a sense of, how much we like the company, what are some of the key risks in our head, and really assessing that on an ongoing basis. So that's how we sort of think about the deal process and the framework of due diligence and thinking about the thesis and the risk. But that's at a high level. And again, we'll dig a little bit deeper into this with the case study. But, I can try to pause here and see if you guys have any questions.
Hey, Brian, I've got a quick question for you. As you're talking about this entire process, obviously it's dependent on the size of the deal you're trying to source and the company and the market conditions, but what's a basic timeline here? From from originally finding a company and saying, hey, let's really take a look at this. Let's dig into the economics. Let's dig into the environment that it's operating in, and model it out and try and structure a deal. Again, I know that's probably a loaded question, but yeah, just a basic timeline, if you could elaborate on that a little bit.
No, I mean, that's a great question, and it really depends, right? It really depends on the timing of the financing needs of the sellers or people who need the capital, right? So sometimes they move at a lot faster speed, and especially if there's an auction involved, right? If it's like a broad auction where multiple PE sponsors are looking at the opportunity and try to win at the opportunity, we definitely have more compressed timing on those. I would say, as usually I generally see about 2 or 3 months from, since the sourcing of the deal to close. But I mean, I've closed deals, within a month. I mean, that has definitely happened before, and it's not ideal because you always want to dig in, understand the business, and make sure that you're covering the risk. But, it does happen, and you just have to move at the speed of the market and sort of where the customers, need the financing needs. So that's how we look at it. Usually 2 or 3 months is on the average, but I've seen as short as 1 month.
Awesome. Thanks so much.
And some of that, Alexander, I would also just note is that while we're doing our work, there are other, we call them third-party people doing their work. So if there's like a quality of earnings report that needs to be done, or something else, or regulatory due diligence that needs to be done, all of those reports also are parallel work streams to what we're doing, and they usually generally take some time. So sometimes as quick as everybody might want the deal done, it's also contingent on all of those other parties doing their work and coming together, providing the reports, and then having people be able to digest the reports, and perhaps if there are any changes that need to happen as a result of the reports, working through that as well.
So the other thing that just happens from a private equity perspective, right? If we're getting the deal in, and Melanie and her team are working with a sponsor, right? We're getting the deal in and we're sending it to 3 or 4 people like Melanie and getting their views on the deal, because not every lender is going to like your deal, right? So Melanie would likely call and say, hey, this is great, we'd like to work with you. And then they really start partnering with you, and they work through your process with you. But a lot of times their information is then being funneled through our organization if she's working with a sponsor. And then Melanie, I don't know, do you guys work with multiple sponsors on the same deal? Because that is another thing that a lot of lenders would do. They have 3 or 4 chances to win a deal because they might have 4 great partners that they're working with.
Yeah, I would say, Greg, certainly when I was at GE, I mean, we would have a deal in that was in the market from 4 or 5 sponsors. So we'd have, we call them Chinese walls, but we'd have walls set up so that there's different people working with each individual sponsor, because you can't cross information that way. For us at Anagenesis, because we're a small team, a small firm, and we don't, I mean, we've played in auction processes, but that hasn't been our core part of our business. We haven't been in a situation where we've represented 2 different sponsors, but in larger organizations and larger firms, that happens all the time, to Greg's point. Which you're essentially competing even internally. So it can be quite an interesting dynamic that's happening for sure. Does anybody else have any other questions, or we can move on to the next slide?
Just a point on pricing. I think, can you talk about just high level differences on like a senior lender, the general range, and a junior lender, the general range, kind of how that plays into the debt side of a deal?
Brian, you want to take that and I'll hop in?
Yeah, I can start with, I can just give a really high level, and then Melanie, you can get into the weeds as well. But I mean, generally speaking, so, and it also depends, on the size of the company, the credit characteristics, as well as how much leverage you're putting on. But, kind of like at a high level, I would think that on a senior debt, you get paid L plus 400, L plus 500. And then as a junior lender like us, we look for pricing, somewhere in between 10 to 12%. So that's the difference that we're talking about.
And one of the other interesting things to note about this is that when you're talking with Anagenesis or a small team, they move fast. You're talking with the decision makers. It's a super small team, as opposed to a senior lender commercial bank when you have multiple steps. And when you have $10 million that you got to do on a debt financing in 2 months, that's one of the biggest, like a huge benefit of going with a private credit firm, is that you're talking to the decision makers.
So Jordan, that's a really good point. Just to touch on the pricing for a moment, when Brian's referencing L plus, the rate that he will mention, L stands for LIBOR, if you guys are familiar with that term. So some people are familiar with prime because a lot of other types of traditional consumer financing is tied to prime, but LIBOR, as you know, it may or may not know, it comes in 30, 60, 90 days. There's different levels of LIBOR. You can research it online. The rates are published, but it's kind of the generally accepted floating rate within our industry, although it's changing. LIBOR is essentially going away, so that's going to change over time. But when we're saying LIBOR plus something, it's plus that basis point. And right now, rates are really low. So typically what happens in deals is people will put something called a LIBOR floor, which means you'll do a deal and you'll say, okay, you'll have a floating rate. So say it's LIBOR plus 400, for example. If LIBOR is only less than 1%, say it's, 0.32%, that doesn't even really give you juice on your floating rate return. But if you put in a floor, it means, okay, at no time can LIBOR be less than 1%. So if it's more than 1%, it's whatever that current rate is, but it cannot go below 1%. So a lot of deals will have a floor in it because lenders don't want to get caught upside down where LIBOR goes so low that their rate isn't what they expect. So for senior lenders, they usually do floating rate. They'll do LIBOR plus something. For junior lenders, a lot of times it'll be a fixed rate. So it'll just say like 10%, 12%, whatever it is. Those are generalizations, but those are two distinctions. And then Jordan, to your point about speed, it's certainly true. It's one of our other competitive advantages because when we're working on deals, whether it's my partner, Jerry, or myself, we're on every deal. And so whoever we're talking to knows that they're talking to one of the decision makers. And essentially, as we're moving through the process, we can be really transparent and we can act with speed. If Brian and I, like this deal we'll talk about in a moment, it was Brian and I on the deal team. So we're, going through it and that's who they're talking to every day. When you're at a large organization, like where Brian and I came from at GE and now Cap One, there's different levels. There's a ton of processes, and the challenge is if you're someone like Greg, who's relying on us in an auction process to go win a deal. And I say to him, Sam at GE, and I say to him, Greg, I'm going to be there, but I have to go through 2 more committees. I might get to my committee, my 3rd committee, and it could have nothing to do with the deal that I'm presenting. Maybe some other part of the organization had an issue with that subsector within healthcare. Maybe we're full up on our commitments at this point. They could come back and say, sorry, we're not going to do the deal. And now I've essentially left Greg at the altar and I could potentially blow up his deal. So that's a big risk when you're dealing with larger organizations. You're typically having to go through multiple steps, multiple committees. Those committees are not connected to the deal and can leave private equity firms in a lurch. And for me, for many years being on the front lines at GE, and then prior to that, even my previous organizations, what I learned very early in my career is I would rather say no to a deal with a private equity firm and not leave them at the altar. Or if I started to hear noise or caution internally, I would say to somebody like Greg, hey, listen, I'd love to work on this deal with you. I'm happy to keep working on it, but you should find a backup plan because I don't know if I'm going to get there. And I would rather tell them to have a backup plan. You either have to split a deal or lose a deal than leave them at the altar. If you leave a private equity firm at the altar and blow up their deal, you're probably never going to see a deal from them again. And if they're really pissed at you, they'll go to the market and tell the rest of the market that you left them at the altar. And that can be devastating for your career. So fortunate for me personally, I was really successful in what I did. And I didn't have to fight for every deal or feel compelled that I needed to do the next deal in order to get my bonus. So I could turn down deals and push deals to other people if I didn't think we were going to get there. And that's really what creates long-term relationships. and Greg, I don't know if you want to touch on that, but, or if you've ever been left at the altar, but it's an important aspect is as these guys think about joining the industry and being really transparent and honest with what's happening.
I think the you know, the one thing that Melanie and Brian are touching on, right, is process management, right, which all of you guys know how to do in the organizations that you run. And there's internal and external processes when you get into the financial services sector. And yes, in 08 and 09, I do remember having a pretty spirited discussion with somebody who tried to charge me 20% for senior debt right after the collapse of the financial markets. So yes, that and to your point, I've never done business with that individual ever again. So.
And Greg, your point about process management, guys, in positioning yourself, really play up the process management side of what you have done. And then now it's just a matter of understanding what the process is and saying, hey, I've been doing this for 20 years. You know, process management, I know how to manage this. And then as you start to then connect that to, yeah, I can actually speak to the debt process, speak to the M&A sale process. It's going to make it so much easier.
Well, and as I know, I've spoken to some of you guys here, right? I think, you know, thinking about your world as planning, process, and execution, that translates directly into an operating role, a deal role, as you can see that Brian's talking about, and, you know, the ability to translate your time in the military in those key buckets, and hopefully with an internship is an easy way for, you know, Melanie or I to be able to go, oh, I get how you can fit in my organization. Like that's those are important skills to have.
That's true. Okay, great. Well, if no other questions, we'll flip here to the next screen, which is really around talking about sourcing, deal pipeline. We know this is small for you guys to have a look at, but we'll touch on specifically what's on the screen. We thought we'd take a moment just to talk about sourcing more broadly. So we get our deals from folks like Greg, private equity firms who are looking for debt and equity co-investment alongside of their debt. We get deal opportunities from founders of companies that are looking to need growth capital. We get deals from other people in the industry, and for Zach over at Backbone with Britt Terrell. Britt and I have known each other since 2006, and Britt has shared deals with us in the past, so we've worked with Britt directly. And then we get deals from investment banks who are either running full-on auction processes to sell businesses, or maybe they're mandated to go out and find debt financing for a particular business. So they're running an auction process, but it's more for debt financing versus a majority sale of a company. And in terms of sourcing deals and originations, you know, this is my strength within our firm, and it has always been my strength from an industry perspective. And I think in general, on the private credit side, this is certainly the case at GE and the case at Anagenesis. And Greg, you touched on this when you touched on your pipeline, but the hit rate for the number of deals that you have to see to what you close is pretty low. So I think you had quoted like 3%, if I remember, 2 or 3%. And that's certainly the case we've seen for private equity firms. For our firm, it's, you know, at GE, it was about 10% for me from deals that I looked at to deals that I closed. For us at Anagenesis, because we have to be even more selective, we have a very focused portfolio. You know, we're in and around 5% of what we see, we actually end up closing. So if you think about the funnel that you have to be able to close a deal and the amount of work that it takes to get one closed, I mean, there's a lot of places where you're saying no, or it falls away, or you're doing diligence and it doesn't work out, or you lose a deal. So to actually get to a close, and we always say, like, don't celebrate until the wires have moved, because anything can happen till the wires move. When the wires move, you know, you'd think you'd have a big party and be all excited, but typically on that call that you have, which is called a closing call, where the lawyers confirm everything has been done, everybody's ready to wire their money and wires can move. People typically say, like, congratulations, but they're so exhausted by the process. They're like, congratulations, and then just breathe. There's no like popping of champagne or enjoying things. And then usually you're on to like the next 20 things you have to do. So Greg, I see you smiling, so I know it's the case for you as well. But you know, we closed 2 deals on New Year's Eve which you can imagine trying to close a deal on New Year's Eve we were literally wiring at like 5 p.m. on New Year's Eve. So, but at that point we were so exhausted, everyone's like, hey, you can go celebrate. I'm like, are you kidding me? Like feel like I haven't slept in like 7 days. So there was no celebration. But those things happen, right? So the point being that you have to source a lot of deals to close deals. And from my perspective, to the point I was just making earlier about being transparent, being honest, being willing to lose a deal to save a relationship, that's always been my strategy from an origination perspective. I'm a long-term relationship player. So I'm not willing to potentially blow up a long-term relationship to get one deal. I want to see repeat deals. I want the reputation in the market to be, if we say we're going to deliver, we're going to deliver. We're going to keep our terms similar to what we say we're going to do unless something changes. If something changes, be very transparent about that. So I think being open and upfront and honest and developing long-term relationships, and relationships are not just about doing deals. There's so much more than that. We talked about, interacting with people, having to spend time with people. If I want to do deals with Greg, I can't just call Greg and say, hey, do you have any deals for me to work on? I need to add value to Greg. I need to say, Greg, have you just heard about what's happening in healthcare? I think a really interesting place for you to look in healthcare is podiatry. There's some trends in podiatry that could be really interesting. I know you're interested in roll-ups or platforms. Here's an interesting area where, hey, I know there's this company that I think is coming to market. As Greg mentioned, when he did his case study, he actually got that through somebody he had been talking to for a long time who knew it was coming to market, then called Greg. That's how relationships are created. And the other way that relationships are created through personal relationships. So, for example, Brian and I have a situation, unfortunately, where one of our clients' CFO's father passed away. We're going to send him, flowers to acknowledge that, or a condolence gift to acknowledge a passing of a family member. These people that you do business with and you're with for a many, many years, become your friends, essentially, as much as they are business people. And you really have to cultivate those relationships. So Greg, I don't know if you have anything to add to that, but that's how I think about sourcing and just business development in general.
I think that's a great overview.
Okay, perfect. Well, maybe with that, Brian, I'll turn it over to you to just touch on kind of our pipeline, what we track, and Brian's really responsible for kind of pulling our pipeline together. We use Salesforce to do that, and that's the output you're seeing. But I'll turn it over to Brian to walk through what we're tracking and how we're thinking about things.
Yeah, for sure. So yeah, this is what our deal pipeline looks like Melanie just mentioned. I do track this on a weekly basis. And then we utilize Salesforce, and we talk about this during our weekly Monday morning team calls. And this is a lot of different information, right? We have the company names, the deal project names, or the sponsors are, what are the deal sources, what are the business focus, and what in which healthcare subsector they're in, as well as some of the the financials like Ebitda, how much debt they're looking for, and then we also have notes and summaries and things like that. So this is a pretty fulsome document, that we do go through every week, and then we talk through these individual deals, at least at a high level, and discuss the status and the next steps. And then we further largely break this down into deals at the early screening stage, underwriting stage, and also we talk about the deals that are on hold. A lot of times deals do get put on hold for various reasons, right? The company's looking to recontemplate their structure, or as doing diligence, we find something in the deal that we don't like. But they do happen quite frequently, and we monitor these because in some of the cases they do pick back up later on in the process, as the issues are resolved. So this is the pipeline, and then and obviously we also record all the dead deals, including those that we sort of lost on, as well as the deals that we closed on. So this is the snapshot of our pipeline.
Hey, I want to jump in real quick, just because I'm seeing about 1,000 parallels here between this and I apologize for my brothers out there who've had to deal with this, but what we would call a CONOP approval process, or a concept of operations, where it's essentially an operation that a team on the ground wants to go do. They can't just go run out and do it. There's an approval process that it goes through, where if they're going into a certain area where somebody else has interests that may get disrupted, or there's certain types of resourcing, like they need the right aircraft or drones overhead to support their mission or things like that. There's a lot of things that have to be coordinated. And a lot of times the operations staff is paying very close attention to what ConOps do we have in the stack right now and where are they? And the commander is very interested in making sure that things are moving along. And then when it comes to relationship management, if it's something where a State Department or an intelligence organization has to get involved, oftentimes that requires those commander to senior executive type phone calls or some type of explanation of, this is why we think this is very important that we do this, and this is how we're not going to kind of ruin things in your area. I mean, and we have a regular weekly commander's update brief where it's like, all right, what are the ConOps on the deck and where are they in the process? Where does the commander need to get involved to potentially, move something forward that's kind of got hung up for some reason? But I'm taking a million notes in my notebook right now about how this very specifically translates to some of the coordination we had to do to get our operations approved for execution. It looks like almost the exact same thing. It's fascinating.
One of the notes here for the guys is like, get familiar with Salesforce. In Slack, I posted that internship opportunity with the West Coast private credit firm. Like, they have Salesforce, they don't know how to use it. It's not rolled out. So if you can create this kind of reports for them, for example, like, they're institutionalizing, and then just use it as, if you have not used Salesforce, just this is a great opportunity to learn how to use it, because you use it every single day. And it's going to really decrease the ramp up time and also increase your odds of like, yes, I already speak your language, I know what you do.
Yeah, agreed. Greg, what do you use a CRM platform, or what do you guys do for Windjammer?
We use Deal Cloud now. We had used Microsoft Dynamics, but Deal Cloud is effectively Salesforce for the private equity industry. Okay. But it's got a few more tools because it helps you manage your pipeline and kind of your weekly investment committee process.
Okay. Yeah, I've seen emails from them, but I've never used Deal Cloud. You know others who have used it. Okay, great. Well, if anyone doesn't have any other questions on that, I'll keep moving along here. Okay, so now we're going to touch into the specific case study, and I'll turn this back over to Brian to talk about the deal that him and I closed on last year.
Yep. Thanks, Melanie. So yeah, we'll talk through our process again, and again, this time we're going to put some context into it by walking through the deal that we recently closed on, as Melanie mentioned, just in December, so a couple of months ago. And just to provide a quick background, so the company is, we'll call it Project Lighthouse. Lighthouse is a regional behavioral health organization that operates inpatient hospitals and outpatient facilities in the state of Louisiana. So the way to think about this business is that they treat people with mental illnesses that are potentially at the risk of harming themselves and or others, right? So it's involuntary services, very critical services. You get referred into these facilities from primarily the ERs, the emergency rooms. So that's sort of the high level background on the company. So we got this deal in from one of our PE sponsor relationships who was looking to acquire the company and was looking to put some leverage on it. So they're looking for a debt capital provider, right? So once we received the same, again, the overview material on the company, we discussed the team whether we liked the deal or not at a high level. And then once we thought that this opportunity was worth pursuing, we then decided to write what's called a new deal summary. That's a term from Anagenesis. And that's basically the screening memo that you see on the right side of the screen. It's a 4 to 5 page document. It's after you conducted your initial research and the analysis on the company and the industry. And just to kind of come back to the senior associate VP role, You obviously have continuing discussions with your deal teams, but as a senior associate or VP, you're generally responsible for doing this, doing the analysis as well as the write-up. So that's the format of the screening memo, and on this one specifically, we really like the industry here. Behavioral health industry is very solid. I mean, there are multiple reasons for it. One being, continued lessening of social stigmas for receiving these types of services, increased government and payer support. So continued supply and demand imbalance, meaning that there's a ton of demand for these types of services, yet only limited providers that's out there that can provide proper services. And then also for dislocation from COVID. As you can imagine, since the pandemic has begun, unfortunately, the number of people with depressions, anxiety, and suicidal thoughts have skyrocketed. So that's obviously very unfortunate reality, but that is a driver that we have to think about, how that could impact the business, right? So that's the industry. I think the challenging thing on this one was that while we really like the macro, we like the behavioral health industry, there were certain challenges around the reimbursement that we had to really focus on. And I don't know how many of you guys are, familiar with healthcare, but again, as I mentioned before, reimbursement is really important aspect in many healthcare companies because that's how they get paid, right? The oversimplified way to think about that is revenue is basically price times volume. Volume is the number of patients that that the company treats, and price is the reimbursement rate that the company receives for treating the patient, right? So. And for this company specifically, they had a concentration in the source of reimbursement, in which about 40% of revenue was reimbursed by Louisiana Medicaid. What that means is that the company, was exposed to the economic and health conditions of Louisiana, and because if there are pressures on Louisiana's budget, they can reduce the size. They can reduce the size of the Medicaid program, and the Medicaid program is really funded by the state, right? So that can in turn reduce the reimbursement rates for the company's services, and they can have meaningful negative impact on the company. So as you know, some of the states, some of the state budgets were pressured, especially because of COVID. So we did have to do a lot of work to get comfortable around this issue. And there are obviously some other things that we had to diligence as well. But, I would say that this reimbursement risk was our number one risk that we really had to dig in and understand and get comfortable with. And lastly, after you sort of do your initial research, you develop an early read model to figure out what the company's free cash flow generation looks like, how much debt that they can support, what our initial returns look like. And I think at the end of the day, the goal is to really to form an early view of the company, right? Do we like the company and the opportunity, and what are some of the key risk and diligence areas that we will need to focus on, right? And finally, providing guidance to PE sponsors, investment banks, or the management teams on, how we think about the opportunity, what's our view, and provide leverage read and issue term sheet. So that's sort of the screening stage of how we think about it, how we go about it at Anagenesis. I can pause here and see if you guys have any questions.
Yeah, Brian, I've got one brief question. And Melanie, you brought up the hit rates you have on you see a deal and what percentage of the time you actually close that deal. How many of the deals, from inception on day one to seeing it, do you actually vet through this process, right? I mean, are you spending time to go through this on every single company, or is this, hey, we looked at the basic fundamentals of this business and now we're going to take it to the next level?
Brian, you want to take
Melanie,
that?
do you want to take that one? Sure, yeah. So I would say anywhere between probably 20-25% of the deals that we get in, we go through the stage of writing up the new deal summary. A lot of times, we read the deal, and then you're right. I think we do find things that are trickier for us. So, that we can provide the feedback on and then be upfront about it early on. But if we, do look at the opportunity, if we like it, there's a path forward here. Then we do go through this stage, and I think 25%, maybe in the upwards of 30% too. That's about how many deals that sort of goes through this early screening stage. I don't know
Yeah,
if Melanie had different thoughts.
Yeah, I was just going to add, we have things called desk kills, which means they come in and for whatever reason, we'll see something about the deal that it doesn't fit within what we do, or there's something about it we know we don't like from the onset, and we call that a desk kill, which is like an immediate no. If it's something that we see that's interesting, that we want to provide a leverage read on, or if we want to provide a term sheet, we'll go through this process. And part of this is back to the point about certainty and transparency and whatnot. This allows our team to look at all this information and establish if it's something that we want to continue to learn more about and move forward in our
Perfect. Thanks, everybody.
And Brian, to produce this, what materials have you received and from whom? Is it a SIM that you get from the sponsor? And then how long does it take for you to scan that SIM on a Monday in order to produce this the next Monday, for example? Like, can you just talk a little bit about the process to create this?
Yeah, for sure. So a lot of times we at least have the SIM and from the sponsor, whether it be the sponsors or the investment banks. Sometimes we have a little more materials because, if we're engaged from a PE sponsor and they've done some work on the company, then we do get those info. Sometimes we also have additional dialogues with the sponsors or the management teams before we put this together. With that, once we have the SIM in, and then I start digging in right away. Even before we start having team conversations, I started learning up on this case, obviously the behavioral health industry, which I'm actually was somewhat familiar with before. But, if it's any industry that I'm not familiar with, I start reading things right away, whether that's via, we have access to Capital IQ. Capital IQ has a lot of different industry reports. I sometimes, give guys that I used to know from Capital One a call, and then they're, experts in the field just to pick their brains on it. So I go through that initial research process, and I would say, once I receive the SIM, I can, pull this together, as quick as within 2 to 3 days, and then obviously I would be working the full, 2-3 days to kind of pull this together. But usually I think, we want to have a team discussion first, not rush into it if we don't have to. But I would say if we have a week, that's plenty of time for me. But generally, I would say 2 to 3 days to pull this together.
The other thing I just wanted to touch on, when you're reading a SIM, a confidential information memorandum, if it's coming from an investment bank, you have to read what's in there. And Greg touched on this a little bit too when he was talking through his case study. You have to read what's in the SIM, but also what's not in the SIM. So one of the benefits of us being industry focused and having years and years of being in the healthcare space is, and to which Brian just alluded to about looking at other behavioral health deals, is that when you're looking at this deal, you might read the information, and if you don't know healthcare, you might not even realize, oh, Medicaid, one state Medicaid is a risk that we have to really work through, because the SIM might say like, hey, everything's fine, or maybe they won't even address reimbursement, which is also equally as crazy in the healthcare world. But sometimes you have to think about what is missing out of the documents and ask questions around that, because SIMs are really sell-side documents. So they're meant to really dress up the company and provide the business in the best light. And some of them are really salesy and others are pretty, direct to what the company looks like. But it's about understanding that not all the questions are from what you read. Some of the questions come from what aren't you reading that intuitively should be there. And, at the benefit that Brian and I have, and our other colleague, Scott Clark at Anagenesis, is that when you're in this space for a long time, I was, focused on healthcare for 9 years. And even for me personally, in that platform, I reviewed over 550 healthcare deals, just myself, for deals that I generated for that platform. But then every week we were also doing, 2 credit committees where we're talking about deals, and everybody else, not to that level, but everybody else is generating deals too. So at any point in time, Brian and I have probably been exposed to, 50 different behavioral health companies. So when this one comes in, we kind of know, oh, here's some general things we need to look at and where we need to focus. Now, not all industries you have to have that level of really industry expertise. But in general, if you're at a firm and you do a deal in manufacturing, the next deal that comes in that's manufacturing, they'll probably have you work on it because now you've seen one, and just over time, you get that skill set, and people just kind of look at you as the internal person that might know a specific industry. So if there's no other questions here, we'll just keep going.
Okay, yeah, and in terms of the underwriting, that's like after the screening stage, obviously, we move on to the underwriting stage, which is more fulsome dive into the company. And this is a process where you are diving deep in order to better understand the company and specifically focus on some of the key diligence areas that we just talked about. And the way that we do diligence, we look at materials provided by the company, the bankers in the form of the files posted to what's called the data room, and we can talk more about what the data room is. But and then we also work on diligence questions list, and have multiple calls with the management team or the sponsor to get clarification and understanding about the company. We also will have access to what's called a third-party reports. So these are basically diligence or analysis completed by other third-party firms that have significant knowledge and an expertise in a specific function. For example, for accounting, Big Four, KPMG, Pricewaterhouse, Deloitte, would do a lot of the accounting due diligence in what's called the quality of earnings, and that's basically to validate earnings. And consulting firms like McKinsey or Bain would do industry or market studies. And for healthcare, companies like Farragut or Marwood would do reimbursement studies. And then these are very detailed diligence, and it takes months for them to complete as well. And we rely on them because they have significant domain expertise. So that's on the third party. And then we also do our own independent research, as I mentioned before, whether that's by doing our own meeting, more about the industry, researching their competitors, and et cetera. And then we also would like to call on industry contacts or experts. On this one of the key contacts that we had through Melanie's relationship is that we were able to talk to a gentleman who used to lead Tennessee Medicaid. And he had a significant knowledge in the sector and then just the overall Medicaid programs. So we utilized him to get thoughts, and then that was hugely valuable, right? But again, just to kind of come back, the goal of this to get really deep into understanding the key drivers of the business, and again, the environment in which they operate in. And as I mentioned before, on this specific deal, we focus a lot on getting comfortable with the reimbursement dynamics. And then that's what I put on some of the analysis here around that. I know it's hard for you guys to see, but it's basically talking about some of the key themes about Louisiana Medicaid. Medicare was also another large portion of their revenue, so we dug in on that. And what the experts think about the reimbursement environment in the future. It's really collecting different data points, getting industry experts' opinions, and using that to really form a more solidified view, right? So once we're done with this, right, we also ran models. We sensitized and looked at what the company's earnings would look like. Had their reimbursement decreased by 3% or 5% or 10%. And the takeaway here is that the company can withstand some meaningful reimbursement rate pressure, but this is some of the work that we have to go through to truly understand the business, the drivers of the business, sensitize it based on what we've learned, and try to get comfortable with it. So,
you guys do a scorecard in terms of like key things and how you're rating that?
We do not. I did back in GE Capital and Capital and Healthcare. They definitely had a more sort of way of looking at things that's sort of within what they call is within the strike zone. If it's outside the strike zone, it's almost impossible to get that deal through. I think we try to be more flexible around it. I think we do look at deals on a deal by deal level basis. But I think the strike zone at some level, just to give us a sort of like sense of, where this deal is in terms of the characteristics of the deals, and just the general parameters of deals. I think that's something that we should think about going forward too. But right now we don't have that as part of the process.
I didn't know, for example, like management or industry risk, and had a scale of 1 to 5, and it was like red to green. I didn't know if you had that kind of system, for example. I've seen one other firm, and Greg, I didn't know you had.
Yeah, we don't look at it that way.
Okay.
Greg, I don't know.
I would say, as your firm grows, I think Brian just said that at GE, they used to do that. I know at larger firms, they tend to have more kind of process and protocols put in place because they can't just sit down like Melanie's team can and say, hey, let's talk about this. We're probably going through some of those growing pains now in terms of having to put more processes in place than frankly we'd like to have, because we like to view ourselves more as an entrepreneurial organization. But you start to get to a certain size and you need to have a way to kind of calibrate across the portfolio.
Yeah. Okay.
Maybe for Alex or Tyler or the guys who have gone through like Training the Street and other courses, like what you're seeing here, are you getting exposure to this level of modeling in the courses that you're doing?
I'm still trying to figure out how to not use my mouse. So no. No, I haven't got this deep in the courses I'm looking at yet.
Yeah, Jordan, I haven't either. This is awesome. I've literally got 4 pages of notes, so I'm getting so much out of this. It's great.
Yeah, awesome.
Maybe Brian has another job as a professor that we don't know about.
Training the Street whenever bonus doesn't come in.
Brian, don't get any ideas. We need you. Okay, switching on here. We're just continuing on the underwriting process. Brian, I just flipped the script.
Yep. So just the next page is just about kind of like wrapping up and then summarizing the diligence findings in a detailed memo. Again, we kind of said 35 to 40 pages. Really depends. I mean, if more analysis are warranted because it has a lot more risk, then we can go above that. If it's a little more simplified and easier business to understand, then it's probably less than 35 pages. But this basically highlights the various detailed analysis that we've done right in the model pages. And again, it really kind of comes back to validating our investment thesis, and proving out the key diligence areas, and then how we will look to mitigate risk. And that's a summary, right? And so once we have this memo wrapped up, we go into the investment committee to talk about the deal. I would usually kick it off and give an overview about the transaction, the background, what I think about the credit, what diligence we've done to get us comfortable. But also, while this is like a formal IC meeting, we do have team calls and ad hoc meetings in between. So if meaningful things do come up, then we definitely, do discuss more as a team more often. So, but in terms of the IC, the formal IC committee, I go in, I talk about the deal, the committee members ask questions and things like that. But with that being said, Melanie and Jerry are the committee members who are making the final decisions. But whenever you're not staffed on this specific deal that is being talked about in this meeting, you are asking questions and participating. That's sort of our model, and it has worked out well. As you can continue to learn, to think about, and then from the other side of the table, and try to pick holes on the thesis, and just bring other perspectives, right? And also, I think you're being part of the discussions in the key decision making. So that's sort of our model. Any questions there?
Okay, if not, we'll go on to closing the deal. This is when you should be getting ready to pop the champagne.
Absolutely. But once the deal is approved and then we've won the mandate to move forward with the deal, then we go on to negotiate legal documentation. And I won't spend too much time on this because it does get pretty technical. But just a few things that are always kind of thematic for us, and things that we focus on are, one, Ebitda adjustments. So adjustments are basically where companies want to normalize their earnings, and usually ends up being in an increase to their earnings. I think Greg also touched on this last time, but if a company, for example, had a one-time discretionary expense, say the owner of the company had a private plane, right? But that expense won't continue going forward for the company because that owner will move on from his role, and the company won't need to incur the expenses anymore. Then they're basically adding back that expense, and then that's rolling up into their earnings or EBITDA, right? We just have to be really disciplined though around the adjustments and giving them the appropriate adjustments, and not the ones that are not well justified, because that could mean that you're now dealing with made up earnings that is not really representative of the company's true free cash flow. So that's Ebitda adjustments. And also on the covenants, given we are debt investors, we generally have covenants in all of our deals. I think the most popular one is the leverage covenant. So that is basically the ratio of debt to EBITDA. And what that allows us to do is if a company starts going sideways on performance and so your EBITDA starts declining, that allows the lenders to kind of come back to the table to renegotiate terms. So covenants is definitely an important aspect for us. And then lastly, cash leakage, another key concept for the lenders. And this is basically where the lenders are limiting the amount of cash that leaves the business without our permission. And then we would sort of rather have the cash be reinvested into the business or pay down debt. So I think those are some of the key themes of the legal negotiation. And once that's wrapped up, we go on to closing and funding the deal, where again, senior associates and VPs would spearhead that process as well. So.
Melanie, what is the most egregious and or interesting adjustment that you have seen?
Well, I would, not to get too long into a war story here, but I was working.
Greg, why are you coming in on video for that one? You got some stories there?
Employee bonuses.
I saw one time that just said loan to employee, but it was a excessive loan to an employee, like $550,000, and the employee was an administrative assistant. So we wondered why an administrative assistant was getting a $550,000 bonus. And I was working with a private equity firm on this deal. And so they asked a seemingly obvious question to two male founders. And the one founder turned to the other founder and said, "Do you want to take that answer to that question?" And you could tell there was like some whole story behind this. And so they said, "We should probably discuss that over dinner." And as it turned out, one of the founders had an affair with the administrative assistant and got her pregnant. And that was like her hush money to like keep it quiet. So like, but don't worry, we're going to pay that off before we sell our business. But they just did an Ebitda add back to it.
Greg, the bar is high.
No, I have nothing like that. Mine is truly when somebody, like, people have a bonus plan in place and they get paid that bonus, and then they say, "Oh, they did really well that year, so we paid them more. So we need to get an add back for paying bonuses." Like, you're not going to take money away from employees as the next owner of the company, right? So the add backs, you're trying to figure out, hey, is this an appropriate level of cash for me to service my debt and grow the company? And the first thing you're not going to do as a new owner is come in and go, "Hey guys, you guys are all making way too much money, and so we're gonna reduce your compensation." So that to me is the most egregious one. And this $300,000 private chef, that was a good one too. Oh, yeah, that was a family member though. So it was.
Man, I'm in the, all right. But I think one of the interesting points here is this is where it becomes the art of financial modeling, to understand where the questions are asked. so that, I mean, this is the difference between, Brian associate versus Brian senior associate, VP and above. It's just, just understanding that these little nuances. But cool, guys, awesome. Thanks for answering that.
Yeah, no problem.
Yeah.
So now we are going to portfolio management, which is after closing the deal.
Yeah. So on the portfolio management side, just quickly, that's one. It's about continuing to stay on top of your accounts, and I think this is actually a little bit different from how the PE, the private equity sponsors operate versus how we operate. Because private equity sponsors will want to continue to sort of go on and look for opportunities. A lot of sort of active involvement, as part of the board members. And then really being, helping drive the growth of the company versus for us, I mean, we definitely care about a lot of that, and we want to grow the company. We want to help grow the company, but just lesser active involvement is, sort of like a hands-on active involvement. But obviously, we are tracking the financials performance. You always want to know what's going on around the business to react to things quickly. Again, whether that's responding to any incremental financings, amendments from the company and the sponsors. And just maintain that clear view of how the company is doing is very critical. Again, for disciplined portfolio management. And then we do take 4 seats in the majority of our deals, albeit I would say half are board observation seats versus the other half are some form of voting seats. And that'll also be a part of the strategic conversations and again helping drive the company. But as again, kind of coming back to the primarily as a primary lender, our role is kind of focused on supporting the sponsor, being a good partner right to the sponsor, and then helping the company grow, right? So in that aspect, we do help people get connected to other industry contacts who may have certain connections. We have former CEOs and executives of many different healthcare companies on our advisory board, and also through our other more formal and informal relationships. And we're always looking to add value, right? We're always looking to add value for our partners, and I think that's how we think about it. So this is my last slide.
Brian, back
Yeah.
back on the other one. I think it's important to note here that there are different styles of debt investors, like distressed debt investors, and there's a different way to owning a company. Maybe just highlighting high level on that, of what that means and how that's different from others.
Well, I mean, it really depends on what kind of investor you are. I mean, if you are a lender, but you have taken control over the company because your company isn't going through a bankruptcy, then even though you're a lender, you also sort of own the company, right? And you're trying to get your money back in that aspect. But for us, I mean, we are investing in performing and growing companies. And a lot of times we're taking what's called a minority share, right? We're owning anywhere between 10 to 20% of the company. That does give us a seat at the table and the voice, and then really help help and become a partner to the sponsor and the company to grow the company. But we're not taking controlling share of the company like the private equity sponsors would, right? Whenever they do a leveraged buyout, they would take the majority ownership of the company. We don't do that.
Yeah, and just on the point of the distress, Jordan, I mean, your point, we're investing in companies that are performing, have good cash flows. We're growth investors, meaning, our upside is through growth of the company and also not through like, doing financial engineering of the balance sheet. So not doing like highly levered deals or doing distressed deals where a company is in trouble and we're coming in there and providing, buying it at a low valuation and then turning it around and taking the benefit of that change of management or whatever needs to happen at the company to make it better. We're buying stable businesses and then helping them grow through acquisitions and organic growth.
Great, thank you.
No problem. Okay, Brian?
Yeah. So and on this page, I just wanted to highlight just a few skill sets that I think are important for senior associates and vice presidents. And again, I'll layer in some of the context as I'm walking this through. The first one on the list is critical thinking. I think this one is hugely important, and I think it's a bit of a mindset. It's that you don't always take things at a face value and really try to figure out what the truth is, and then just having an independent opinion. One example that I would bring up here is, I think Melanie also touched on this before, is when we receive the SIM from the investment bankers, you have to realize that that's a sales material, right? I mean, think about you're trying to sell a house and you've engaged a broker to put together a 10-page summary of your house. That's exactly what SIM is, but it instead, describes a company. So you have to be careful because, that summary could be sounding a lot rosier than what the reality is. And a lot of times they're putting a nice spin on things. And I think your job is to really figure out what the reality is, what the truth is, versus, what people are telling you and then their narratives, right? And then that's like, how has the company done in the past? How are they doing now? What do you think they'll go in the future? And you should collect enough data points, but you should be the one that draws your own conclusion, right? And the critical thinking skill set, this differentiates like hugely, like an analyst and associate level. Like some analysts and associates are very good at this. They know how to think critically, make up their own mind, have their own views, and speak up about it. Versus some are not, and that just draws a huge distinction between the two. So I think that's really important. And then similarly, but this is more about how you make decisions. And I think in investing, you make decisions based on analysis, right? I mean, whether that's based on certain sets of data or themes in the industry where you might not necessarily have the data. It's about driving the conclusion based on thorough analysis. But with that, I think it's also important to stay open-minded because you'll always get new information and things change very quickly in this world, right? And I think if you have sometimes too much conviction about something, that you're not letting yourself into other possible new information, and that could be dangerous because that creates blind spots, right? So you should certainly know how to draw conclusions and make decisions quickly, but you should be also flexible. That you can kind of adjust to new info as well. The next one, diligent and detail.
Brian.
Yeah.
Brian, if I can hop in real quick there. Obviously, or I imagine that it's highly quantitative analytical decision making, but it also seems like there's a lot of room for like kind of qualitative analysis of what's going on as well. Especially when, like when you're talking about, getting towards the end game and looking at cash leakages and things like that. As you're going through here, like how do you see the balance, or do you have any examples of where like one might have overridden the other as you're going through a decision-making process?
Yeah, I mean, I think that's a great point. I mean, one aspect of it is I think you always have to balance the high level things versus very company specific. So having a view on an industry, having a thematic view on the industry is very important, right? Knowing what's going on with the industry, that's more like qualitative stuff. And you're not going to always have all the data points behind the industry, but just think about, call it the oil industry or the printing business, right? I mean, I'm sure there are a lot of companies, that, were performing fine. And then if you look into the specific data points, they all look great. But if you take a step back and look at the bigger picture issues, the industry was going down south, right? So like that's something that you would always have to balance, like looking at the bigger picture. And I think also kind of pointed out here, looking at the bigger picture, taking a step back versus also kind of doing your analysis, based on the data, right? Does that make sense?
That makes a ton of sense. Is that bigger picture qualitative understanding of what is going on here, but you also have to have the kind of like micro quantitative, like things are lining up. That makes a ton of sense.
And Tyler, I think Greg touched on this when he did his case study too, but at the end of the day, you can run all the models you want. You can do all the financial analysis you want. We're backing people. So we can't overstate the importance of strong management teams. And strong isn't just skills on a piece of paper. It's also to those softer skills of transparency and trust. And do you think that if an issue does arise, that CEO or CFO is going to call you and chat about that? Developing that level of connection and partnership with the management teams is so critical. If I think about almost all of the deals that I know of that went left, it's because something happened with management. And so, really digging in and making sure you understand who you're working. It's such a people business because people at the end of the day are going to be, making the company do what you want it to do. And if you have an issue with the management team, that can tank a deal and totally change any model that you've tried to create in Excel. Okay, Brian, keep going.
Yeah, just going on to the next point, the diligent and detail oriented. I mean, that almost kind of goes without saying. The diligence process takes a lot of work, a lot of synthesizing data and information, asking a number of questions, clarifying, concluding, and putting that into an explainable story, right? It's a laborious process, but definitely an intellectually stimulating one. So you have to be wanting to roll up your sleeves to dig in. But again, as I mentioned before, it's very important to also maintain your perspectives. Balance with bigger picture issues. Take a step back and balance with bigger picture issues. Sometimes we get so hung up on very specific detail that you're just kind of missing out on, what's going on with the industry. Do we like the management team, like Melanie just talked about, and things like that. And then the next point is, manage projects and then communicate effectively, both with internal teams as well as the external customers. Always know how to tell a story with data. I think that's a very important skill in investing. And obviously communicate with conviction. And then lastly, as Melanie touched on, again, develop and build industry network and relationships. I mean, they can be a great resource if you want to go ask some questions, get thoughts, or it could be a good deal, source for a deal flows in the future as well, right? And as we know, this is a reputation-heavy business, and people really drive the success of the business. So being able to work with others and have good relationships, I think, are definitely critical. Melanie, did I miss anything else? This is obviously coming from a senior associate VP myself, but also kind of coming from Melanie. Would love to, hear your thoughts as well.
No, I appreciate that. I think just a few quick points on this point too, and we only have one other slide, which is from HA's point of view, how she thinks about the internship side of things, but a few points I just want to touch on here. When you guys are coming into this role, when you think about, particularly if you're at a firm if you're at a private equity firm, think about who your peers are at lending sources or investment banks, whoever your peers would be. Reaching out to them and developing a relationship with your direct peers is really critical for a reason I'll mention in a moment. For Brian at our firm, having him reach out to his peers at private equity firms, investment banks, and such is also important. The reason why I say that is when I started my career, I used to think like, oh, I'm an associate, I'm going to call the partner at, KKR. That person's going to take my call and start showing me deals. And of course, like that person's never calling me back as an associate at a firm. So then it occurred to me that if I create relationships with my peers, hopefully over the years as I'm growing up in the industry, they're also growing up. And that's been hugely successful. I mean, I have relationships from people that I met right when I entered the career who are now leading firms, or they were, moved up to partner or managing partner at their firms and now have spun off and created their own firm. All of these people, if you connect the dots to those people, are going to either stay at their firm and rise up or go elsewhere and rise up. So Brian and I have been working a lot with, and me sitting in my world, working with Brian on a number of deals. I encourage him to develop those relationships. So deals that, like this deal that we just walked through together, he's gotten very close with the VP and the associate at that private equity firm. They talk all the time. They interact, exchange emails, call one another. They're developing their own relationship. And then, of course, I have my relationship with them, and then I have my relationship with the partner at that firm as well. But it's really important for me to make sure that I help him foster those relationships. So as he advances in his career, he can also develop those relationships and then also generate deal flow, because those guys are also, men or women, have the opportunity to also have a say in who they should go to for financing solutions. And so hopefully that connection they make with Brian continues to push deal flow our way. The other thing that Brian, I think, touched on a little bit here, but what I really appreciate about Brian is he does his own independent research. So he might see something in a SIM or like that deal that we worked on that had Louisiana Medicaid exposure. He didn't just take what we heard. He was on Louisiana's state website learning about Medicaid in Louisiana. He was being very proactive to think outside of the box and bring material to the deal process that wasn't actually presented to us, whether it's validating what we've seen or provide additional information. And even back to the pipeline report, which seems like a simple thing, but kind of gets lost in the day-to-day activity. He actually went back and said, oh, Melanie, I was thinking about these last 3 deals that we worked on together, and here's the result of what happened. One didn't get sold to who we thought it was going to get sold to. These 2, here's who actually did their financing, and this is what the deal looked like. By doing a simple Google search around the name of the company to figure out what happened. And now him and H are going to do that for our entire look back of our portfolio. But he's very proactive, and he always is raising his hand to do more, which I just love that about him, his level of proactiveness and his level of going above and beyond to validating or provide additional information that's not just right on the surface. Which is why now he's promoted to VP.
Now I just heard your rationale, Melanie. I appreciate that.
No problem. So just wanted to share some of that with you guys as you think about coming into these roles and how you can be helpful to the people that you're working with. And maybe what I will do is turn this to the next slide. And last but not least, Aisha, you've been listening all along the way so intently and quietly. Maybe you have some things to add based off of what we presented. You can touch into what you've put together here in terms of your observations around working with us and some tips for the folks as they think about taking on internship roles.
Okay, yeah, I will try to make this quick, but these are just a few things that help me structure an online internship and keep myself accountable. And firstly, set specific goals. What do you want to learn in this few months? And for me, this was bimodal, as Tyler also pointed out. First, qualitative analysis skills. Since my undergrad career was not really finance focused, I felt like I had to gain some critical thinking skills in the scope of finance. And then more technical analytical goal where learn more about data analysis and profit projection. And then have a learning plan with different objectives. I borrowed this framework of 4 different buckets from one of my advisors, and I really like that, knowledge, vision, practical skills, and personal management. And these are not always be given to you. Sometimes you have to do extra research. You have to set up specific meetings to achieve these goals. And then know your weaknesses and find people and resources that can help you to improve. And I think this is especially important if this is your first time interning in a specific company or in a specific industry. And as a lot of people mentioned, take Excel classes, SQL classes, learn more about Salesforce, identify what you need to, what technical skills you need to gain. But also know your strengths and be vocal about how you can be a valuable asset, even if you're an intern. For me, I think I'm very tech savvy, so I offer help whenever I think I can be efficient while solving a tech related problem. And follow the news, follow the markets, and read every document that you have access to. Do your research, as Melanie said. In certain industries, you can get away with the bare minimum info, but finance is not one of them. You have to do a very extensive research to understand. And then I found this last point to be especially valuable for an online internship. Be an active participant and join all of the calls and meetings if you can make it. And ask questions and don't be afraid to set one-on-one meetings, even if your manager is not working with that team. You can still learn a lot from like people working with different teams, working on different projects. And create checkpoints and schedule follow-up calls. This is mostly to keep yourself accountable. And I think it's important in finance because deal analysis is time sensitive and the process will be very fast paced. So try not to get lost. And like lastly, communication, because I feel like as for any other industry, like timely responses are fundamental for being efficient.
Yeah, and I would just say, Ishay does a great job of this too. When we were implementing Salesforce, we had to put in all of our contacts, and I was literally like doing that manually. And I told her, hey, we have this project, we have to input all of this manually. And I thought her head was going to explode. Like, there has to be a better way. And she reached out and said, Melanie, listen, give me access to these, custom, I don't even know what you call them, wizards or something within Salesforce. She's like, I can do this in no time. And I'm like, how did she even know that? She's like, I was doing research around how to do this, and I just found how to do this. And now, like, I just need these tools, and now I can do it. And she did it so quickly. So I was telling her, I love having somebody like her who is tech savvy around to say, oh, this is what you were going to do. No, I can do this, so much easier and faster than how you were thinking about that. And so that's been great in working with her. And she's also very inquisitive. So if she's listening to an investment committee, which she participates in all of that, she'll follow up and say, okay, I was understanding that, but I'm not really understanding that. Or why did you guys do that? And I really appreciate that about her, that she'll take notes and follow up and ask those questions and show us that she has an interest in doing that. And then her and Brian have been working together on a number of things to get her up to speed with some of the nuances of what we do as well.
I think one of the big takeaways here is that, you being familiar with understanding Excel and PowerPoint inside and out is the difference between going home at 9 p.m. versus 2 a.m. and when you're at the last part of a deal. And I really like that mentality of there has to be a better way to do something if you're looking at 1,000 lines of data. And I'm completely guilty of doing this for the past 10 years and not learning how to do it a better way. I'm going to manually do this on the Excel sheet. Why not? It's a good use of time. But the other takeaway here, or one of the other takeaways, is just the learning plan. It's such a good idea. Lay out your learning plan for financial modeling, for explaining what is that credit process that we just went through, or what is the M&A process? You can look at that book, Investment Banking. I think it's chapter 7 or 8, and I put it in the Slack channel. I love that idea of a learning plan.
Mm-hmm. So that concludes our formal part of our presentation. I know we went extra long. Hopefully that was helpful for you, and happy to answer any follow-on questions.